Hello everybody, and welcome back to Perpetual Pip. It's time for another lesson here, and we're going to be focusing once again on our Trading 101 series. We're very close to the conclusion of this series, and for today, we're going to be talking about what is a stochastic RSI. Okay, so quick review here based on what we've discussed so far. We've been building up to the culmination of this series from the beginning until now. So far, we've been able to understand and master that the market moves in waves, never in a straight line, that we can identify the overall trend direction by using trend lines. The intensity of that trend can also be measured with how aggressive the trend lines are. We can track and trade the waves by using the Fibonacci retracement tool, right? Either monitoring the ABCD pattern or the Elliott wave pattern, essentially the exact same thing, except for the fact that Elliott waves expect the market to reverse after about 5 waves. We also know that we're looking to determine the entry from the candlestick formations, right? For the highest percentage chance of success, we're looking for a candlestick formation that confirms the overall direction. And we talked about fine-tuning that entry by using counter trendline breaks to determine a viable point to enter into the market, where if the market is no longer retracing, right, that's what our counter trend lines measure, retracement action. If the market is no longer retracing, then it should be getting ready to extend or go in the direction of the trend. So now we're going to improve upon that a little bit more. We're going to start to talk about an indicator. Now, this indicator is known as the Stochastic RSI. In certain platforms, they've shortened it and they've called it the Stock RSI. And essentially, this indicator is just an oscillator, right? It just waves up and down, and it has the ability to track the momentum of the waves. Now, where do I get that from? From that following acronym, RSI. RSI stands for Relative Strength Indicator. So effectively, what this indicator does is it measures who's in power, either the bulls or the bears, who's pushing right now. Now, a really common misconception about this indicator, just so you know ahead of time, is that this indicator should be used to identify trend direction. Now, I've got to go ahead and I put it into the text just because it's that important. It is true that you can use this to confirm trend direction. And if you have any questions on this, don't hesitate to email me directly, will@perpetualpip.com, perpetualpip@gmail.com, or you can use the contact form directly through the website, whatever's easier for you. But while it is entirely possible to confirm trend direction or the intensity of a trend, it's usually pretty redundant, right? This involves identifying what's known as a peak high and a valley low. I'm not going to waste time with it purely because I believe that it is redundant. It's unnecessary. Why? Because you can see on the candles already whether or not the current high that's being created is higher than the last one, or the current low that's being created is lower than the last one. You can see it on the chart. So using the indicator realistically doesn't really give you any information that you're not already privy to, so I don't generally waste too much time with that. But if you want to know about it for the sake of knowing about it, feel free to drop me a line. In any case, let's talk about what the actual indicator looks like. And there are a few variations to this depending on your platform. We'll talk about that in a minute. But essentially, this is what the indicator looks like. You usually have an upper line and a lower line, generally in red, but again, it's going to depend. The upper line area, the area above the upper line is known as the overbought zone. And the area below the lower red line is known as the oversold zone. So between these two lines, a range is created. And in here, inside this range, this is known as the buy or sell zone. Okay? Now, I will go ahead and discuss later on an alternative description that you may have heard somewhere else. And I just want to make sure that you can bridge the gap between the two, because essentially it means the same thing. The only reason why I don't subscribe to the second teaching methodology is because it can potentially generate confusion, and that's the last thing that I want to do here in my discussions. So effectively, what you're going to see taking place on this indicator is you're going to see that there is a line oscillating up and down between the overbought and oversold zones. Right? That's all this indicator is. It's just a waving oscillator. Now, here's what I mean about this indicator. What you will generally see, and we're going to look at this on a chart next, but what you will generally see is this indicator is going to wave up or down regardless of the current trend. It doesn't care if the trend overall is bullish or if the trend overall is bearish. Instead, what this indicator tracks is relative strength. So as of right now, who is pushing in what direction? You will see, and we'll take a look at it on a chart, but what you're generally going to see is that when the bulls are pushing the market upward, you're going to see an accompanying move in the bullish direction. When the bears are pushing the market downward, you're going to see an accompanying wave in the bearish direction. When the market enters into this overbought area, you can literally consider that the market has been bought too much. The bullish momentum has been exhausted, the bulls are tired, and more than likely what's going to take place next is a move downward. Same thing for when the market enters into the oversold zone. You can expect that the bears have exhausted their momentum, they're now tired, and the bulls are more than likely going to follow up with a move upward. Okay, so this area in between is going to be considered the buy or the sell zone, depending on which direction this is pushing. As this comes from the oversold zone upward, this is considered the buy zone, this in-between area. And as long as the market is in between this, you can consider it to be moving in the bullish direction. Or you can feel confident maintaining a buy position. If the market is U-turning from the overbought zone downward, then this is now considered the sell zone, and as long as the market remains in this, expect that your momentum, the momentum is in the favor of the bears. You can feel comfortable holding a sell position until it becomes oversold. Just because the market enters into the overbought or oversold zone does not mean, again, we're not using this to determine trend direction. It doesn't mean that a full-on reversal is going to take place. It may simply be indicating the beginning of a retracement. All right, so let's take a look at this on a chart. I'm going to go transition over to, I've got a separate workspace for these types of teaching discussions. I don't ever want to do this on my actual analysis pages because I worry about risking the analysis that I already have on there, maybe move something out of place, forget to delete it. I can have these episodes of cranial flatulence, it happens. But in any case, this is the trading software that I use, tradingview.com. Now, this is going to be this indicator is relatively similar across multiple platforms, right? No matter what platform you're using, MetaTrader, online platforms, whatever the case, NinjaTrader, doesn't matter, right? One of your broker platforms, doesn't matter. The indicators is pretty close to the same. Now, if I go to my indicators menu here on TradingView, select that, and I use this little search. If you have this option, it's really handy. Instead of just scrolling through all the available indicators, that can take some time. Just search for it. If you have something that's more desktop based, you may not have this search icon or this search window, but usually they have at the very least linked it to your keyboard. So if you type something on your keyboard, whatever the letter is, it will take you, it's usually in alphabetical order. So if you use the S key, it should take you down to stock RSI or something like that. All right. So essentially that's what we're looking for, either stochastic RSI or stock RSI. Here it is, stochastic RSI, and I'm going to just click on it to add it to my chart. Now right away you can see that this is somewhat different from what I showed you. The reason for that is because it is typical for some of the newer platforms. In the olden days it used to be very simple. In the newer platforms, I guess in order to help you feel like you're getting more bang for the buck, they've added additional lines. For me personally, I think simple is best. So I usually go into the settings of the indicator or the format, right? And in the settings, what I'll do is you usually will have multiple lines. On this platform, it's pretty good about letting you know what the lines actually are. On some platforms, it may indicate it as a main series, right? One of your lines may be indicated as the main series. The main series is known as such because it's good enough, right? Main series is what's really keeping track of the waves on this chart. Now, I generally, this is letting you know in this platform, it breaks it down several tabs for different options that you can tinker with. These are the inputs. I generally don't mess with the inputs unless I'm looking to compound it, but that's something for the live sessions. We'll talk about that later. In style, I can go in here and the main series, as it's known on some platforms, or the K band, is the line that I'm going to use. So I usually just make sure that this is active. Now, if you've got a platform where you have %D or %D slow, these are additional or extra oscillators that they tack on to this indicator. I'm not going to say that they're useless, right, because that would be untrue, but these other lines, these additional lines of %D, %D slow, are based on a much larger average, which gives you a slower indicator. The stochastic indicator is already a lagging indicator because it has to wait for candles to close before it calculates the average price action. So I don't personally like to add to that delay. So what I generally do is I will disable the %D, %D slow. You can see already it's gone. So now I just have one oscillator waving up and down here on this indicator. I will usually thicken this middle line, the K line or the main series, just so that it's easier on the eyes. It's completely up to you. You don't have to do that. But I generally try to make it, it's your charting software, so make it as easy to see as you need it to be. For the upper band, this is the overbought line that we talked about. The upper band, I generally color it in red. Again, you're not obligated to use this color scheme. It's just what I prefer to use. Right? Now, the value that I do use often is this 80% value. And by default, most of these stochastic indicators will have this 80-20 situation. So I have left that alone. I'm not going to tinker with that. Same thing for the lower band. The value is where I want it to be. I like this line to be solid. That's just a personal preference. It's just a style choice, right? But I'm just making these changes so it's easier for me to see. I've thickened the line there. And the last but not least, this is background, this thing in the middle. They like to color in the buy-sell zone on this software. I don't generally bother with that, so I uncheck that. That's pretty much what you saw in the drawing that I showed you. Okay, so this is my very basic, simple is best in my opinion. This is my very basic stock RSI, stochastic relative strength indicator. Right? Depending on your platform, you may have a few more options to tinker with, but again, to keep things nice and simple to be able to observe these waves, I would strongly suggest the main or K line. With that said, I'm going to click on OK, and now we see that there is this waving indicator at the bottom of the chart. Now, it can be a little difficult to make sense of this when you're looking at candles and then you're just seeing this thing waving up and down. However, what I'm going to do to help you bridge that gap is I'm going to expand this, and I'm going to actually superimpose the candles above the stock RSI. And now we're a bit more able to observe what we were talking about before. Can you see here that while the bulls, these are bullish or green candles here, you can see the slope moving upward. While the bulls are pushing the market upward, you can see the market moving the same accompanying upward slope on the stochastic indicator. It is independent of the overall trend direction, right? All this is keeping track of is the wave. So as the bulls push the market upward, you see the accompanying candlestick formations here. When the bulls get tired, or this market enters up here into what's known as the overbought zone, we'll label that here on the chart, overbought zone, you will notice that what happens next is the bears, since the bullish momentum is now exhausted, the bears take their opportunity to press their advantage and they start forcing that market downward, right? And you can see the accompanying now bearish slope as the market moves further down, right? This is exactly what we're looking at. This is how we use this indicator. When it comes to tying it in for more aggressive entries, you can look to incorporate your counter trend line break with a stochastic U-turn and a candlestick formation, and this combination is the trifecta that I like to look at for a higher % chance of success, especially when it's in the direction of the trend. Okay, this is how we're using the stochastic indicator. So we are tying this in to the overall trend direction. Right here we can see that this market is making lower lows, lower highs. right? So if I were to put in my trend lines, they would look like this. Okay, down trend line, inner trend line, and now we have inner, outer, and long term. So if we start taking a look, and I want to encourage you to do this on any currency pair, any time frame, because this is going to be the exact same methodology no matter what currency pair, what exchange, what time frame. Technical analysis is the exact same. So I want to encourage you to take a look at this, because the more you take a look at this and practice it, the more confident you will become and the more able to execute it effectively you will become. But I want you to start taking a look at this and practicing it on your own when you see the break of a counter trend line tied in with the stochastic U-turn and a candlestick formation. You would be amazed to see the accompanying moves that occur in the direction of the trend. You're going to be amazed. What you're going to find is that when you see this trifecta, this holy trinity, if you will, of signals lining up in the direction of the trend, the subsequent move in the direction of the trend is absolutely amazing. Okay? This is how we use the stochastic RSI to help confirm entry. Now, with that said, this brings us to the conclusion of this basic overview. Hopefully you've enjoyed what you've learned. If you have any questions, feel free to direct them straight to me, will@perpetualpip.com, perpetualpip@gmail.com. As always, I'm at your service. If you want to start putting rubber to the road, be sure to join us at our live market trading sessions. If you want to learn more, get the ability to interact live with fellow traders, feel free to join us right at the website, perpetualpip.com. Don't forget to like and subscribe for more additional free content. And of course, all the content is available on our website as well under the Learn to Trade tab. All you have to do is create a 100% free account. I'll see you there. This has been Will Gomez for Perpetual Pip. Take care.